Investing is a key component of your financial plan. To be successful, one of the most important traits you need is intestinal fortitude. Reaching for return introduces some emotional stress, and sometimes that stress can be intense. Big decreases in value may cause many people to sell investments, and most do it when they shouldn't. Today, Mike and Tyler join me to talk about the difference between investment return and investor return. This is Wealth Wednesday. Hello, welcome back to Wealth Wednesday. Thanks for joining us today. If you'd like to learn more about our firm, visit cfswv.com and also check out our YouTube channel. That is at Commonwealth Financial. Today, I'm joined by Michael Cease, a financial advisor in Parkersburg, West Virginia, and Tyler Zaffron, a financial advisor in Wheeling, West Virginia. Guys, investment return and investor return are totally different, and sometimes that difference can be substantial. In fact, not too long ago, Morningstar released their Mind the Gap study that shows over the last 10 years, the difference between investment return and investor return, the way they calculate it, is about 17% or 1.7% per year. Tyler, let's start with a base definition of what we mean.
Yes, and thank you for having me, Neil. So when we're talking about investment return, if you are looking up the performance of a specific investment or an index of a fund, it would be the return of a percentage of gains per year over a specific period. That would be your investment return. So we're actually looking at a specific fund or a specific investment, and we're looking at a specific period of time. And what that percentage is, that's going to be your investment return. The thing about the investment return is it's not going to have any personal subjective opinions to it. That's what the facts are stating. It's going to be limited to no trades. No trades are being done on what's being held during that period. And it's a simple point-to-point result. Now, with investor returns, it's what happens when you look at the performance of your own personal investment portfolio or your accounts over a specified period and compare what you have earned and how that meets your personal expectations. So this measure is going to include your personal decisions within the context of the investment portfolio, both good and bad. It's going to be looking at things such as the impacts of trades that you've done, of withdrawals, distributions that you've taken from the account, market conditions that you are subject to in that period. Flows of money that are coming in and out of that account. If you're putting money into that account, if you're taking money out of that account, that is all going to be taken into account to effect with your investor return.
Mike, you and I have been doing this for a while, and we've both been through two of the worst bear markets in the last 50 years, and also two of the best bull markets we've ever seen. We've seen people make good choices and make bad choices. Why is investing such a mental challenge?
It comes down to one thing, Neil, we're humans. I mean, that's one of the biggest things. We've all heard about their fight or flight responses before that humans have. And our brains work no differently. Our brains are just wired to want to protect what we have. So when things aren't going well and people see their account values decreasing, there's a strong emotional response to try to protect those accounts. And there's been several behavioral finance studies done over the years that have shown that the emotional pain of losing is twice as strong as the emotional pleasure of gains. So when you see your accounts drop 10, 15, 20, sometimes 25%, it's a big challenge to fight our natural instincts not to try to protect those accounts and try to protect what we've accumulated.
Tyler, I'm going to paraphrase Yankees Hall of Fame catcher Yogi Berra. He said that baseball is 90% mental and the other half is physical. Successful investing is 90% mental, isn't it?
It is. Really, I don't know if it really has to be. It takes realigning your investment goals and your market outlooks, as well as your personal thought processes. Look at a company like Amazon. Since it went public in 1997, it has been one of the best performing stocks. But if you look at its investment return, it would be, of course, very impressive. But the journey to get there was very challenging. Let's look at all the things that we had to endure between now and 1997. Amazon had to endure 2 price drops that were almost greater than 90%, a number of 60% drops, multiple times when the price was cut in half, including recently in 2022. These types of drops is going to test a personal conviction in the company, as there's going to be no assurance that it would become the company that it really is today, and that it's maintained its brand and its brand awareness and its market. In the long term, it continues to build and continue to grow and continue to expand into different markets and to different sectors of the markets. And even this week, there was an article from Amazon struggling in the grocery industry, and it's still working out those kinks. So as an investor, which we all are to a degree, we have to take a serious look at our goals and realistically measure the risk to reward outlook.
Right. And it's always key to remember that we're buying shares in what we hope are good businesses. Mike, as financial advisors, one of the key areas we think that we add value is to help people avoid some of those bad decisions. Can you expand on that?
We know that down markets are hard on all of us. No one wants a downturn. I've been through 50% drops in the stock market during my 27 years in the business. And with that being said, the market historically has always come back. And not only does it come back, accounts continue to grow, wealth continues getting larger. So especially when you don't sell during those times that you think you want to get out of the market. Clients have an emotional attachment to their investments. It hurts when things go down. It hurts when they get those statements. So as advisors, our emotions aren't tied to the investing side of things. Our emotional investment is helping our clients achieve the good outcomes and helping them reach their goals. So I kind of believe that we as advisors, we have a responsibility to the client to kind of be their guide on journeys. And what I mean by that is we're set there to guide them through when times are good and when times are bad and help them stay on the path. And sometimes our job is fairly easy. If the market's going up all the time or for a period of time, we don't have to hold hands as much, but we have to be there when times are bad. So we look at all of our clients' journeys through a different lens is what I'm really trying to say. For example, we want to know, what do our clients need to be able to get from point A to point B and be able to retire when they want to and have what they want when they retire. We want to know, how will the decisions they make today, because they've worked so hard to obtain what they have, how do we make sure that money gets passed on to a loved one or to kids or grandchildren in the future? So that leads us to helping you make some really tough decisions that might make the client feel really uncomfortable at certain times when the market's going through its up and downs. However, with that being said, if we help them and we're a good guide for them, we really think that 5 or 10 years out from now, they'll be in a much better position than they were when they started, especially if they don't make those emotional decisions during those downturns.
Staying on track during these challenging times can be hard. We went through the COVID pandemic, we went through 2022, and many others have been through much, much more. But we have a team that can help you. Guys like Mike, guys like Tyler, and the other 8 advisors on staff. We can all help you get through that journey. And if you'd like to contact one of us, please visit cfswv.com. And if you like what you saw today, please like and subscribe. Thanks for watching. We'll see you again next week.